Welcome, everybody, to today's edition of PropTech Talks. We've got a fantastic founder, a little bit of a background here. Natan was one of the first clients we ever had with PropTech Connect. Before our first event, we saw Built AI, and this was when a lot of the initial talks around AI were starting, what the implications were, though, and there still is today, of course, a lot of noise within AI, and then also a lot of actually practical implication that people are getting a lot of value out of. And Natan was on our radar to work with, and I called Natan and I said, you guys should be involved in our event. And Natan said, looks exciting. What are you thinking? And I said, well, I hate to ask, but I'd actually like you guys to be a sponsor of the event as well and be a client. And keep in mind, this was an event that never happened, that Natan hadn't heard about from a guy he didn't know. And he said, sure, let's do it. And yeah, we've, I guess, I would say stayed mates since. But little backstory. So Natan, good to finally have you on the podcast.
Thank you so much for having me.
Cool. So let's learn a little bit more about you. You've had an interesting career. You're one of those who I would say has been through both sides. It's quite fair to say from a more traditional background. I see you worked at Goldman Sachs, worked at Citi, not starting at the best time. And now, you know, since 2021, you've been building Built AI. So tell us about your background and what led you to this point.
So as you mentioned, I started my career doing investment banking, doing M&A. That experience was incredibly helpful. I got the foundations for what I call my financial acumen training. It was a pretty good school to be working for 4.5 years doing that type of role. Very painful, but I would say it's worthwhile. It's just like going to the special forces of financial acumen training with no sleep and a lot of work. And after finishing my time at Citigroup, I decided that I wanted to basically move to the buy side, and I joined a real estate private equity fund called Benson Elliot that was run at that time by Mark Mogul and Trish Barragan. It was focused on value-add and opportunistic investments with a pan-European approach. It was also fascinating that, and it's something that not a lot of people do, is that they also merge the acquisitions teams with the asset management teams. So I was fortunate to be able to see the whole life cycle of a lot of the deals that I was working, from origination, acquisition, and ultimately through disposal, and being also involved through value creation, through different asset management initiatives as we were holding these assets. After my time at Benson Elliot, I left to join another fund that was just being started by another individual. This was being backed by Korean capital, so I joined as employee number 1. Cool. And I was responsible for growing this platform from 0 to over $2.5 billion of assets under management, and doing everything from, again, origination, underwriting, asset management, setting up the platform, legals, and also relations with the investors.
I'm going to ask you what might be a silly question, sure, but when did you work harder? At Goldman or as an entrepreneur?
It's a different type of work because, well, the problem that you have in some of this banking and some of these institutions is that you have no control of your time. So you can't plan. It's very hard to have a control of your time and your life. Anything can happen at any point in time. Whereas as an entrepreneur, you definitely have more control over your time. But more importantly, there's an alignment of interest for every single hour that is being spent. The more you work, the more you're building towards your equity value. And as such, for me, I'm not shy of working as hard as I can as an entrepreneur, because I know that every single hour that is being invested, there's a return on investment of that hour that is into the business that we have founded. Whereas you can't say the same about some of these other institutions.
Now, I don't want to go... Your answer was so interesting that now we are going to have to talk about it in a little more detail. But how do you think you can get that same kind of alignment out of a team? Because Goldman Sachs definitely has done a fantastic job at propagating a level of motivation and action out of their team. Yes, I think people end up burnt out, but at the same time, you do have these incredibly driven individuals within Goldman. How, just from a team building perspective, how do you get that kind of alignment out of a team?
Yeah, it's a little bit hard for those type of roles because especially when you're at a junior level, it's very hard to quantify the let's call it the product that has been delivered by some of these team members. It's not like you could put a number. Let's say if you're in sales, it's quantifiable because you can have a number, and then if you hit your number, then you can share the economics. But a lot of these roles that are a little bit more subjective in terms of the performance, it becomes much harder to just compensate people and create an alignment of interest because you just don't know. There's no clear benchmark or metric if you're doing well or you're not doing well and how you're competing against your peers. And also I would say that the level playing field is not equal because different teams might judge different people differently, which means that it becomes even more complicated. So going back to your point to incentivize the team, there has to be clear KPIs that could be measured, and there should be a share of economics where people are aligned. Whereas, that going back to my point, that extra hour of work people can see what they can get out of that.
Makes sense. Cool. Just another interesting point from your background. When you first joined the buy side and you were looking at value add and opportunistic deals, so I would argue the more exciting of the spectrum. Are you seeing similarities to the post-financial crisis when people moved away from sort of just buy and hold and starting to look at a little bit more opportunistic and value add, and today where buy and hold seems and core investments are seemingly shrinking, just holding an office and hoping for the best. That did work for a 10-year run in the 2010s. Not so much a common strategy today, but there is a lot of repurpose, there is a lot of refit, and there is a deeper inspection on the assets within a portfolio and the portfolio on the whole. Are you seeing that similarity? And of course, the conditions, I guess, are a little bit different now. What do you make of it?
It's quite challenging because, as you said, back in the day when interest rates were extremely low and there was a constant yield compression, you could make a lot of mistakes in your underwrite. So, for example, you could make the wrong assumption of what you were going to be leasing up an asset, and it happened to us. I remember we underwrote an asset and we had crazy assumptions for ERBs and how much rent we were going to expect. But what ended up happening was that as yields started compressing and we sold the asset, we basically erased all of those mistakes because one of the biggest, if not the biggest drivers of the returns is the exit and the yield that you're assuming at exit. So we erased all of those mistakes. So it basically, that my favorite quote comes from Warren Buffett, where he was saying, when the tide goes away, you can see who's been swimming naked. So by the tide going away means no yield compression, no forgiveness. So what that means is that people nowadays are much more forensic, much more thorough when it comes to underwriting and the actual performance of those buildings because they cannot be saved by future yield compression as what we've seen in the past in this cycle.
And so I mean, that on the one instance might sound a little bit scary for the investor who may have been quite used to a post-08 environment. However, it also sounds like a healthier industry, more driven by margin, profitability, more sensitive to where value is really being added. What do you, without getting a little bit too high level, what do you actually think is gonna happen in the next 5-10 years?
It's a tough one. I think we need to look a little bit before 5 years. So in the past couple of years, there's a lot of managers that have bought assets at quite, low yields. You could say that they're overpaid. There's going to be a lot of refinancing that is going to be taking place in the coming years, and of course, values have gone down for different asset classes. So there's going to be a lot of equity that is going to have to be deployed to plug that financing gap. So we're going to see a lot of that. And we're going to see a lot of managers that might not have the opportunity to inject additional equity, and they're going to have to dispose or hand out the keys in a lot of these assets. We're starting to see that. I think that rates will start coming down, but I don't foresee an environment where we saw in the past couple of years where we had rates at close to 0%. Those days are gone. So people will have to be more comfortable with the new normal, which is interest rates, I would say in 2.5% to 3%, which is the long-term average that we will have seen historical. Yeah.
I mean, and I think that does set a pretty clear picture. And I think real estate sort of, I guess it is clear, real estate has had it somewhat easy. And now it's not, you don't necessarily get paid just for owning, you now start to get paid for problem solving and understanding, which sounds like a good thing. However, at the same time, there's a very big elephant in the room that we're not talking about, and it's the two beautiful letters that everyone loves, AI. And by I think it was Pi Labs who released a paper recently, and they said there are three potential outcomes realistically. It's all actually just a big nothing burger, and this is more the generative side. It's all a big nothing burger, and the amount of data that these models can actually utilize, well, it caps just due to the infrastructure of how these models are built. And the hallucinations will increase, and then we're all kind of looking into it almost too deeply. See, then there's the other extreme, which is a quick route to AGI, ASI, superintelligence, scaling past us, and almost a completely transformed, disrupted world of poverty and total control from machines in some people's guesses. And then what they say is a bit more likely is something maybe a bit more in the middle, which is improved workflows, people having to adjust to new ways of working, utilizing it correctly to increase their margins. You've hinted at AI agents and autonomous workflows. If we now think about those next few years where, the industry does, I guess, have to become a little bit more productive, how does a real estate deal start to look, and where is the human value add actually involved?
Yeah. So I want to talk a little bit about a recent study that was conducted by MIT. I don't know if you saw that they basically took a group of people and they connected them to what's the name, the thing that measures your wavelength of your
MRI?
No, it measures the wavelength of your brain. It's EG, I forget the name. Anyways, so what they did is that they were monitoring. Some people were using AI to draft essays, and other people were just not using AI to just draft essays. And what they were able to, long story short, to understand is that the people that were long-term users of tools like GPT, their cognitive ability started going down, and they call it cognitive debt. They started being more lazy. The way that they were thinking was changing, and it was having a real impact on their brain. So why is this relevant to what I'm saying and what you're talking about workflows? Is because we have to be careful that the tool, doesn't start replacing everything that the humans are doing, but it's actually a tool that is enhancing the type of workflow that you're doing, and you don't lose oversight of just throwing around all of the work, everything that you're doing, right? That quantitative and qualitative side of the business that you're doing from real estate. So it's a very dangerous path because you can start becoming very lazy and just using AI to just do a lot of your work streams, but you might lose the oversight and the and actually your quantitative abilities of what you're doing and you're planning to do.
I mean, it's so interesting because if you imagine, somebody gets an email, how should I respond to AI? AI writes the response. That person thinks, how should I respond?
AI to AI.
I mean, what I think would be quite interesting to look at is where does the human value cease, and where does AI's capability, really actually add value? And I'd like to also understand the built AI product a little bit better within that conversation. So what can you tell me about that?
The biggest value add is that a lot of these firms are operating with multiple different systems, and information and decision making is lying in different places. So you see people that have different software solutions where information it's being stored, and a lot of these workflows have to be manually stitched together to come up with insights and solutions. So for example, if somebody wanted to understand what's the impact of 25 basis points reduction of their overall portfolio and relying to actuals, they're not able to do that immediately. They have to go through 10 different pieces of software and maybe 20 or 30 different people to just stitch everything together. So I think where AI is going to be quite powerful is stitching all of these things together and allowing people to just get access to information, to do decision making much more efficiently, and just remove all of this manual effort around collecting data, using data, and ultimately making the right decisions.
And so it feels quite clear from a, let's call it just a time-saving aspect, right? I mean, if you think about humans being a cost, you've got your humans either doing more, which is great, or you may not require as much. There's, I guess, two ways to look at that. I'm also just wondering about even let's say the investment decision-making side. The question being, how much does AI and these sorts of analytics tools, how much does it actually add to portfolio value in terms of decisions that would or would not have been made, repercussions of those decisions or the premiums you're getting out of those? What do you have anything that even surprises you, having, I guess, worked in this area for a long time?
Are you talking about acquisitions or asset management or both?
I would say even both, or even,
acquisitions,
even thinking potentially a sale. If you think a portfolio that is quite large, I mean, then, you've got these huge spreadsheets, so much data, some poor soul who might overlook something, and actually you could, two assets get flagged, this doesn't match our risk profile. People might not even know.
So I think the issue with legacy tools like Excel is that when you're using a lot of these tools, you're governed by the processing power of your computer, right? So you're running this on premise. When you're using new generation tools that are on the cloud and they're also AI powered, it's almost unlimited the type of analysis that you can do, and also it provides you with the ability to tap into external data to complement the analysis that you're undertaking. So, for example, if you're looking at a tenant and covenant risk analysis, you could tap into these solutions and get an immediate understanding of who are the tenants, what's the covenant risk, and do that analysis at the same time without having to do it manually and go and do your research externally.
I mean, it sounds like quite a transformational shift is then still required because, as we know, most things are still run on Excel. So, something we're seeing quite dramatically is even in the last 2 years since we did our first event, the maturity and the attitude towards technology from first kind of, is it a buzzword? What even is it? To, okay, the industry does seem kind of different, to, okay, well, this is going to help us from a data perspective, which we require, and people, using these tools, showcasing the case studies. A question I think would be quite interesting, especially given your background as well, working on the traditional real estate side. What's a piece of conventional real estate wisdom that you believe will be either irrelevant or even dangerous as we go into this next phase of the industry?
By wisdom, what exactly do you mean?
Yeah, I mean, like maybe a belief that the industry holds that is now no longer about to be holding true.
Well, I feel that when people are underwriting, and you ask everyone when they're doing an underwrite, as we talked about this before, the main one of the main drivers is your exit and how you are estimating your exit and what value are you going to be assuming. I've spoken to a lot of people in the industry, and it's very rare that somebody gives you a compelling answer as to how they have arrived to that piece of information and that thesis. Yeah. So most of the people would just assume no yield. Some people just don't assume no yield compression. They say, okay, well, I'm just going to sell it at the same price that I bought it, and then basically the returns that I'm generating is through all of the asset management initiatives that I have at hand, because that exit is something that you can't really control. It's market dependent, it's uncertainty. The things that are happening in between, which are asset management initiatives, you could have, there's certain control, right? You could do CapEx programs, you could do releasing, you could increase the area of a building, but everything that happens at the end is very uncertain. So I think that most of the people, they with the new tools that are around, the ability to do more extensive research, they're going to be able to find more ways to come up with more compelling analysis when it comes down to making that assessment of what the right exit assumption should be undertaken. So I would encourage you to ask people when they're doing their modeling to just tell you how they arrive to that. And it's very,
Trust me.
Yeah.
Trust me, it'll sell.
Yeah.
So just so I know, because I'm a little bit of a layman on this one, why is it you can't actually sort of comfortably prove? I'm assuming that risk and there's some kind of range when it comes to an assumption for a sale value, but why is it so difficult to be within the range then?
Well, let's start with this. Fundamentally, when you're investing in real estate is it's almost like a fixed financial product that is providing you a rate of return. That product, depending on the risk profile of the building, should be yielding you like a different types of returns, right? So if you have a building that is core plus or value add, you should be deeming more return, a higher return profile. So the way that people look at real estate and why it's so dependent on where rates are is because they look at the base rate, where they say, this is basically, if I put the money in my bank account, this is how much basically free money I can get, and then they apply a risk premium depending on the type of strategy that you're deploying. So it could be anywhere between 200 to 300 basis points. So if we start with the base rate, right, of let's call it 4.25, and you apply a 300 basis points margin, that asset should be generating 7.25%, right? So who can predict in 3 or 4 or 5 years from time, like where could rates be, so you have, of course, you have rates that impact, then you have demographic trends as well. Like, sort of who would have predicted that COVID would have happened, and the way that we shift and the way that we work changes completely. So there's tons of variables that you have to address that could impact the the amount of where you're assuming the exit for some of these assets. So it's incredibly complicated to come up with the right assumption.
Do you think that this is something that potentially a human model, the variability, it's almost like the three-body problem, just the variability means that over enough time it becomes too disconnected from an investment hypothesis. However, do you think this is the sort of thing that actually, with these sorts of variables stacked up, this is where AI can really kind of add more value?
Well, absolutely, because with the tools that are out there, you're empowering people like us to run this type of analysis that would be extremely complicated, time sensitive. It requires a lot of information, and I'm not saying that it's going to give you the magic number, because nobody can predict what is going to be happening, but at least it gives you a range, or like a better understanding of what are the different outcomes that you could be seeing, so that you can be more, when you're doing your underwrite, you can be, let's say, more conservative, and you can do a much more sophisticated underwriting.
Understood. In a world of, let's call it AI washing, okay? I mean, I know you started the business, was it even before the ChatGPT?
It was before. It was before GPT was released, yeah.
So you were a little bit ahead. Now it seems like everybody and their cousin has AI involved in their business, even if it means there's an AI chatbot on their website for inbound leads. But the AI is there, at least. How do you ensure that built AI remains genuinely innovative and a genuine, let's call it like a machine learning value add? And I suppose the second point to this, because this might be interesting for other founders as well who have quite sophisticated solutions, how do you actually educate your clients on this thing that is quite new to them, on what real AI actually looks like in practice and the value it can add?
I think it's all about transparency. What is happening is you have a lot of companies out there that they've created what is called ChatGPT wrappers. So it's literally a wrapper. So they're selling you their solution, but what actually you're buying is, it is a GPT or another LLM, and they claim that they're training the solutions based on whatever their domain knowledge. Mm-hmm. What is happening is we're being, with the products that we're releasing, we're being incredibly transparent that we're working with all of these organizations, because we want to be able to bring in the best piece of technology that is out there to our users and bring that application layer into our platform, so people can benefit from from what the best that is out there, and not just say that that's our piece of technology. So just being transparent with our client base, like the type of technology that is being deployed, who we're partnering with, and what type of services we're providing, and not claiming that we have developed our own piece of technology. Because what you see, which I think is extremely unfair, is that people are paying, they're being sold these solutions that are wrappers, and they pay a massive premium. And I just think, actually, you're just better off just getting an enterprise subscription from OpenAI or Gemini than just having to just go through a third party. It's basically yeah.
And I mean, it does seem as though there is that trend where the industry is a little bit more intentional with who they're working with. Mm-hmm. One sort of trend we're seeing is, after talking to a lot of executives on this, is they're saying, when it comes to technology adoption, we're finding that yes, the technology part is critical. We don't want to screw that up, but equally critical or even above that is actually now the human element. We know the solution works within the business. However, the humans and getting them on this train, that's critical. They say when AI is automating certain things, then our value then becomes in the deal, understanding the person better. I've still got my 24 hours in a day, but I'm spending them less on, looking through a spreadsheet. I'm spending it more on understanding the person I'm about to be working with, and building relationships. So there's almost a challenge to this narrative, is that we are becoming more disconnected as we get more within technology, but actually it seems to be helping us become more connected. For Built AIs, and since you guys have started, what behaviors are really surprising you the most from your clients?
I think we've seen a fundamental shift right now in the adoption of technology. I think what has happened is that the decision makers, which is the older generation, is starting to get fed with. They're probably in their boat in the south of France reading the Economist, and then they come across all of these articles that are happening with like the ChatGPT, Gemini, how the different institutions are adopting technology, and they're realizing that this is something that they have to start taking more seriously if they want to remain competitive. Because before, a couple of years ago, they just thought like, no, this is just a fad, and it's something that it's not going to have an impact. But now, and more, as different competitors and companies are adopting this technology and they're actually quantifying and achieving like some positive ROI, they're realizing that they have to start moving fast. So I think the dynamic has changed, and now we're seeing a lot of inbound. We're seeing people much more open to conversations, experimenting, adopting technology, and being more curious of what this type of solutions could do for their business and how they can help them.
It's actually so true. What blew my mind just when we started was almost the attitude towards technology. And it was crazy, because we just had gone through this point post-COVID, offices, on the decline, rates up, obviously. They needed to get better data for regulatory perspective. They needed to get a better understanding of their assets. They needed a better understanding of their portfolio. They needed to stop burning all this cash. They needed to become more efficient. So it was very clear. And what also was interesting is they were talking about exactly what the issue was. Even if you look at it on the stage on some of the other events, they would say, we do need to become more innovative. We do need to become more... It was actually one of the only things they would really talk about was really the thing that would come up time and time again. And then what really blew my mind is a tech company would go over to them, and almost the array of problems that had just come out of nowhere recently are all sort of seems to be a way of solving it. And there was this huge fear, it almost seemed like, at least at the beginning of this, working with something they just had no understanding of. I've got my own opinion, but do you think this has changed a lot?
No, I think it's the fear of not adopting technology.
So I've noticed a huge shift. I've noticed a huge shift from that attitude. And now it seems that the industry is much, like you said, much more welcoming. But I'm just curious, is this something you're noticing?
Yeah, I think we see it by the level of conversations that we're having, how open people are now to adopting technology. I do think, though, that Europe, we're behind, whereas compared to the US, I think it's just the attitude here. The people here in Europe, they have the attitude that if it's not broken, they should not fix it.
However, it is broken.
It is broken, but people have been doing these things for 40 years. So why they're running, they're still running their operations. They could do it much better. They could be, but it's just a matter of the adoption of technology compared to the US is it's completely, we're behind.
I think that this is a really interesting point because I think there's two big differences between Europe and the US. US, far less sustainability, but actually quite pro-technology and quite pro-innovation. Europe is potentially a little bit more, less eager when it comes to pure technology. However, sustainability still being a pretty fair consideration. The other really interesting thing about the two markets is this range in tech adoption. So overall, the US, the main players in the US, they are looking at technology pretty seriously across the board. In Europe, yes, some players, definitely. However, at the same time, some are in that, oh no, but this has worked for the last 12 years mindset. There is definitely a range. And, my thought on that is, if they don't want to potentially repurpose or understand this a portfolio better or retrofit or, and they're comfortable with, a 300 million decline in asset value on commercial, with not really understanding too much why. There's almost a Darwinistic thing that seems to be happening in Europe, where some winners are taking and seizing, and some are just falling behind, potentially complaining. I think a big difference here is this now a continued just pie keep getting bigger scenario, or is this a pie sort of staying the same size and now just a reshuffling and who's got different pieces of it? Potentially it is growing too, because because the industry is becoming more productive. Anyway, what are your thoughts on the kind of things I'm saying? Is this what you see as well?
Definitely, and I do believe that through the adoption of technology, so people could get information and decision making on their existing portfolios much quicker, so they can be more proactive rather than reactive with things that are happening and opportunities. Yeah. And that's something where we're lagging here significantly. Yeah. I speak with people that don't even know how many units they have in their portfolio, are not aware.
It's very common.
Very common. They have no idea if the debt maturity of some of the assets is what is that compared to the WALT of some of their portfolio. Are they going to be refinancing when there's no income? You're surprised. They're like, what? You should know all of this stuff. But it goes back to what I was telling you at the beginning, where everything is just it's just running in different places that it's impossible.
I mean, that is shocking.
It's impossible to be able to
because a bank might just call in a loan, and it could completely cripple. You might not even know this asset. You do nothing, and it's just going to get taken from you. You might not even know.
Exactly.
And I guess it wasn't an issue for 10 years on 0.5% interest rates. Now it is an issue. But this is the thing I'm actually talking about. There's almost a Darwinistic element here, because if they don't do anything and don't adapt, they're going to literally just lose buildings.
This is
actually quite crazy.
This is exactly to the point where we were talking at the beginning of the podcast, where you have to be much more diligent in the way that you're doing, because there's no forgiveness here. Yield in that particular scenario where we just talked about, if yields move in the right direction, then of course the value of your property increases, and therefore you have more equity on that building, and then that scenario is not going to happen. But if we're not in that situation, you have to be much more diligent in the way that you're doing things, because you could just lose the keys and you might not be aware.
I mean, that is quite crazy. I guess with reflecting on everything, we're talking a little bit about the US as well. I'd like to get a better understanding. What's next for Built AI? Let's go next 5 or even 10 years.
Yeah, so we now have global operations. We're now US headquartered. We've signed some US clients as well. We're starting to do some work in the US market. We'll be able to have a global capability, so not US, UK, and Europe. We're expanding our different product lines across different work streams. through our platform. So not just only acquisition, but valuations, asset management, and creating overarching operating system that works across all of the work streams.
Can you actually break that down for me? So Built AI originally was to help people with
underwrite, yeah.
People underwrite an acquisition?
Correct.
Okay. What does the Built AI suite look like now?
So it's going to follow the whole life cycle from origination. So we're working with some of the largest brokers in Europe, in the UK and Europe and worldwide. Those brokers use our platform for origination and sharing deals with prospective investors. Tool is being used to analyze deals, to do the asset management value. So just going through the whole life cycle of the assets.
Cool. And is this something that has now been built and is being utilized?
Yeah, it is. It's being deployed.
Very cool. Okay. So global expansion, that's always good to hear. I guess the last question, there's a lot of interest right now, new development side, which sounds weird in 2025, but new development side, a lot of interest in the Middle East. What are your thoughts on, we obviously hear about Dubai, looking really exciting, hearing about Saudi Arabia, obviously. Yeah. What are your thoughts on the sort of the growth that region is seeing, the very fast growth that region is seeing?
I think it's a great opportunity because these countries are investing a huge amount of capital to develop, of course, their local real estate. We see in Saudi, NEOM and all these massive projects. But what they're also, the advantage that they have is that they're starting from almost like a blank slate, which means that they could start adopting the latest. Or let's call it, they can just start putting the foundations that are required to make sure that everything is technologically enabled. So in the way that they're running their land registries, in the way that people can access that information, in the way that people can collaborate, there's a huge opportunity in those markets to just to start with the right layer, or not layer, but the right foundations that could allow people to just innovate. So, and they're willing to take those, they're willing to look at technological, and tech and adoption and bring it into those markets.
There's a good example of that is with China and roads. And America, first to really be sort of mass consumption of cars and road usage. China coming in later said, well, now we have bullet trains. So why would we build all these roads when we can just put our infrastructure on these way better things? And they just leapfrogged in terms of
exactly. So
transport around the country.
Absolutely. So they can put those the right infrastructure layer for tech and the application into real estate. That's a huge opportunity.
Very exciting. Is that a region that you're looking at as well?
Yeah, we're looking at it opportunistically, but I think with this business, you have to be extremely focused because there's so many opportunities, but if you chase everything, then it's just very hard. So we have our eye, but opportunistically at the moment.
Understood. And I don't know if you also relate to this, but as you grow, the number of shiny objects and the size of the shininess, let's say, just increases. And then it's really about being selective and sort of what the value you put on your core mission.
Absolutely.
Amazing. Natan, absolute pleasure as always.
Thank you so much for having me. Really enjoyed it.
Awesome.